$713 billion. That is what one company took in over 12 months, ending on the 31st of January this year. For comparison, everything Belgium produced in 2024, every factory, every office, every farm, every hospital, the entire country, came to $671 billion. The company is Walmart. And here is the part that does not fit. Out of that $713 billion, Walmart kept $21.9 billion, 3 cents on the dollar. 97% of the money that came in went straight back out again, and the company's own filings do not stop to explain where. That is the question this film is built on, not how big Walmart is, where $691 billion a year actually goes, and why the number everybody quotes about this company is not measuring what they think it measures. There are two questions here, and they pull in opposite directions. The first is mechanical. How does a single company move $713 billion of goods in a year? That has an answer, and it is a physical one. Buildings, trucks, pallets, and about 2.1 million people, more than the population of Slovenia, on one payroll. The second question is the uncomfortable one. Why does everybody, all the time, compare that number to the economies of countries? You have seen the chart. Walmart bigger than Norway. Walmart bigger than Belgium. It is on news sites, in classrooms, in speeches. In the United States Bureau of Economic Analysis, the agency that actually calculates American GDP, publishes in plain language why those two numbers cannot be put on the same axis. So the comparison is not a rough approximation. It is the wrong kind of number, repeated for years by people who had every opportunity to check. Hold on to that second question. The honest number is at the end of this film, and it is stranger than the viral one. Start with the machine, because the machine explains the 3 cents. Retail is not a business that makes things. It is a business that moves things. A bottle of shampoo arrives at a store having already been manufactured, packaged, shipped, and warehoused, and almost all of what you pay for it is the cost of those earlier steps. What the retailer keeps is the gap between what it paid and what you paid, the margin. So when Walmart reports $713 billion, that number contains the shampoo. It contains the truck fuel, the pallets, the cardboard, the electricity in the freezer aisle, the rent, and the wages of the person who stocked the shelf. Almost all of it is other people's work, bought in and passed along. Now here is the definition that decides this entire argument, and it is not mine. The Bureau of Economic Analysis defines value added as gross output minus intermediate inputs. That is, what you sold minus everything you bought from somebody else in order to sell it. And then the sentence that matters. The sum of value added across all industries equals gross domestic product. So GDP is not a measure of money moving. It is a measure of value being added. A country's GDP has already had the shampoo taken out of it. A company's revenue has not. Put them side by side, and you're counting the same shampoo twice, once in the country that made it, once in the company that sold it, which is fine for a headline and useless for anything else. The machine has a starting point, and it is very small. The 2nd of July, 1962, Rogers, Arkansas. A man named Sam Walton opens one discount store with his brother. Not a chain. One store in a town most Americans could not find on a map. Walton's idea was not complicated, and it was not new. Sell each item for less, and accept that you keep less on each item, on the bet that enough people walk and that the small numbers add up. Every retailer knows that trade. Most of them will not take it, because it only works if you can hold your own costs below the price you have chosen to charge, and the discipline required is brutal. Say it in his position, in 1962, standing in a store the size of a large restaurant. Good. I will take 3 cents where they take 10, and I will take it 100 times more often. End quote. That is a reconstruction, not a recording. But the arithmetic is the documented strategy, and it is the reason we are talking about this company at all. Within 5 years, by 1967, he had 24 stores and $12.6 million in sales. In 1969, the company incorporated. In 1970, it went public, and then the small number began to multiply. Watch what that bet demands, because each answer creates the next problem. Rung 1. Thin margins are only survivable at volume, and volume means you must never run out of anything. A store that is out of stock is a store that trained its customer to drive somewhere else. So the first thing the company had to build was not stores. It was the machine behind the stores. Rung 2. Distribution. Warehouses placed so that a truck can reach a cluster of stores and come back the same day, which sounds like logistics and is really geometry. Build the warehouse first, then open stores in a ring around it until the ring is full, then build the next warehouse. That pattern is why the company grew outward from Arkansas in circles instead of jumping to the big cities. And it is why for 2 decades its competitors underestimated it. They were watching the wrong map. Rung 3. Once you're the biggest buyer in the room, your costs stop being a market price and start being a negotiation. A supplier who sells you 30% of everything it makes cannot walk away from your price. That is the moment the flywheel starts. Lower buying costs, lower shelf prices, more volume, larger buying power. Rung 4. The prices actually did fall, and this is measured, not claimed. Peer-reviewed work by Emek Busker found that when a Walmart entered a county, the prices of everyday goods, shampoo, toothpaste, laundry detergent, dropped between 1.5% and 3% in the short run, and roughly 4 times that over the longer run. Hausman and Leibtag found competing supermarkets near a Walmart priced about 3% lower. So the customer side of this is real money. Rung 5. Groceries. This is the rung that turned a large retailer into infrastructure. Food is the thing households buy every week in every economy, in good years and bad. According to Numerator, in the 12 months to March 2025, Walmart accounted for 21.2% of all grocery spending in the United States. Kroger, the next largest, was 8.9. Costco, 8.5. 1 in every $5 Americans spend on food goes through one company's checkout. And the last rung is still being climbed. In the final quarter of the fiscal year that ended this January, the company's global e-commerce sales grew 24%. The same machine pointed at your doorstep instead of your car park. And there is a 6th rung most people never see because it does not have the name on the door. Sam's Club, the membership warehouse arm, with 600 clubs across 44 states in the last full year reported $90.2 billion of sales, 13% of everything the company sold. A business that on its own would be among the 20 largest retailers on earth is, inside this company, a rounding line in the segment table. Put yourself at the checkout because the 3 cents only becomes real when it is your money. You're holding a $4 bottle of shampoo. Scan it. Now, follow the $4. Most of it, the largest single piece by far, leaves the company almost immediately back to whoever manufactured and shipped that bottle. A slice pays the person who stocked the shelf and the person who scanned it. A slice pays for the building you're standing in, the light above you, the freezer humming behind you, the diesel that brought the pallet. A slice pays the tax. And what remains after all of that is about 12 cents. That is the company's net income on your $4. Now do the thing the viral chart does. Take the whole $4 from every customer in every store on every day of the year and call that total the size of an economy. You can see the problem when it is your shampoo. The $4 was never Walmart's. It passed through Walmart. 3.1% of it stopped. So let us do the comparison properly, once on screen. This is the size of 3 national economies in current dollars from the year 2000 to 2024. Belgium, Austria, Norway. In 2024, Belgium's entire output was $671 billion. Austria, 535. Norway, 501. Against those, Walmart's $713 billion of revenue does sit higher, and that is the fact the chart you have seen is built on. It is also the whole trick. Those 3 lines are value added. What each of those countries produced after subtracting everything they bought from each other to produce it. Walmart's line is not. It is the till receipt. And here's a second way to see that the two numbers are different animals. Walmart's $713 billion is earned by 2.1 million people, which is about $340,000 of revenue per employee. At Nvidia, in the year that ended in January, roughly 42,000 people produced $216 billion, about $5.1 million each. 15 times as much per person. Same units, same currency, completely different machines. A number that big can be produced by moving enormous volumes, a sliver of margin, or by selling a small number of things at extraordinary prices. Revenue does not tell you which. GDP is specifically designed to. Now, the part that surprised me while making this. I went looking for the honest number, Walmart's value added. The figure that could legitimately be placed next to Belgium's $671 billion. It does not exist. Not because it is secret, because nobody calculates it. The Bureau of Economic Analysis publishes value added by industry, retail trade as a whole, manufacturing as a whole, and it publishes it for the economy, but it does not publish it company by company. Walmart's own filings are built to satisfy securities law, which asks for revenue, costs, income, and cash flow, and never asks a company how much value it added to the national accounts. So the single most quoted comparison about the largest company in the world rests on a number that the world's most careful statistical agency would never have put there, and a number that belongs in its place has never been published by anyone. What can be bounded is the shape of it. We know the company's operating income was $29.8 billion. We know it paid about 2.1 million people. Value added, roughly speaking, is what a business pays its workers plus what it earns on its capital. And both of those are far, far smaller than $713 billion. So the true figure is not Belgium, is not Norway, is not close to either. The honest sentence is the boring one. Nobody has published it, and the people repeating the chart never noticed that. And to be fair to the statisticians, they are not hiding anything. Value added by industry is published in detail every quarter: retail trade, manufacturing, information, construction. The reason it stops at the industry line is that the accounts are built to add up to a country, not to rank corporations. The chart asked a question the data was never built to answer, and then answered it anyway. It would be comfortable to say the mistake belongs to the internet. It does not. The comparison appears in newspaper business sections, in university lecture slides, in political speeches about corporate power, and in the annual lists that rank companies against countries as though the two were competing in the same event. Everyone in that chain had access to a one-page definition on a government website. The reason nobody stopped is that the wrong number is more useful than the right one. If you want to argue that a corporation has become too powerful, $713 billion against Belgium's $671 is a sentence that ends the discussion. If you want to argue the opposite, that this is a low-margin business at the mercy of its own costs, 3 cents on the dollar ends it just as fast. Both sentences are true about the same company in the same year, which is your clue that neither of them is a measurement. They are arguments wearing a number as a costume, and there's a cost to that beyond pedantry. When a real question about this company comes up, what it pays, what it does to a town, whether one firm should sit between a fifth of American food spending and the people who eat it, the debate opens with a statistic that falls apart on contact, and the person defending the company gets to win the first exchange without discussing any of it. So what should be measured instead? Start with what 3% actually means when you are that size. A retailer with a 3.1% net margin is a company where a 3% rise in costs, fuel, wages, tariffs, shipping, shrink, would, if nothing else moved, erase the entire year's profit. That is not the position of a country. Countries do not go to zero because diesel went up. It is the position of a machine that survives by being better at its costs than everybody else, every single quarter, forever. That is the actual source of the power, and it has nothing to do with the GDP chart. It is this: the company sells to, by its own count, about 280 million customers and members a week. It is the single largest grocer in the United States at 21.2% of the market, more than the next two combined, which means that when Walmart decides what it will pay a supplier for a case of eggs, that decision is not a negotiation between two companies. It is close to a price for the country. No statistical agency publishes that number either, but you do not need value added to see it. You need only to notice that the thing worth measuring was never the size of the company. It was the size of the gap between it and everyone else in the same aisle. And the machine is still accelerating in the direction where the gap is widest. In the last full year, the company reported it delivered 8.3 billion items to customers on the same day or the next, 27% more than the year before. Same-day delivery at that volume is not a service. It is a second distribution network built on top of the first one, and almost nobody else can afford to build it. And underneath all of it, there is a harder question, which the price research answers only halfway. The prices did fall. That is measured repeatedly by people with no stake in the answer. So the household that shops, there is genuinely better off on the shelf. The other half is contested. And I'm going to give you both sides as the literature actually leaves them, because pretending there is a consensus would be its own small lie. Newmark, Zhang, and Ciccarella, working with a national panel, found that each Walmart store opening reduced county retail employment by about 150 jobs, roughly a 2.7% fall, and county retail earnings by about 1.5%. Other economists, including Busker herself and the work of Hicks and Wilburn, found no significant negative wage effect at county level, and in some measurements a rise in total compensation as the new store hired. Both results are peer-reviewed. The field has not settled it. What is not contested is this chart. It is the real median weekly earnings of a full-time American worker in constant dollars, so inflation is already removed. 1979, $331 a week. 2024, $369. 45 years, 11%. Whatever happened to American pay over the lifetime of this company, it was not a boom, and no single retailer caused it. But it is the number that explains why cheaper shampoo was not a small thing to the people buying it. When the pay line is that flat for that long, the price line is where the entire improvement in a household's life has to come from. So here is the answer to the question we started with. Where do the $691 billion go? They go back out almost as fast as they came in, to the factories, the farms, the shipping lines, the landlords, the utilities, the tax authorities, and the 2.1 million people who are paid to move the boxes. Walmart is not a country. It is a pipe, an enormous, extraordinarily well-engineered pipe, and the water in it belongs to other people. And the honest number, the one that would sit legitimately beside Belgium, has never been published by the company or by the government because no one computes value added firm by firm. That is not a scandal. It is just true, and it means the most repeated statistic about the biggest company on earth is measuring the water, not the pipe, which leaves the real question standing, unanswered by any chart. Not whether one company is bigger than Norway, whether it is healthy that a fifth of what a country eats passes through one till, that the price of a case of eggs is decided in one building in Arkansas, and that the only reason most people can absorb the last 45 years of flat pay is that somebody found a way to make everything 3% cheaper. That is the number worth arguing about. It was never on the chart. One more thing, and then I will leave you with it. Every number in this film came from filing, a government definition, or a peer-reviewed paper, and the single most famous number about this company came from none of those. That is worth remembering the next time a chart makes something feel obvious.